Yeah, so hello and good afternoon. I welcome you to today's special webinar um, here exclusively for JFD Brokers, how to trade the market opening of the US markets. So in fact, yeah, after a Monday, things seem to turn a little sour. Some people might say, hey, great, now we get to see volatility. I'm not that optimistic, to be honest. I mean, all in all, volatility is great, especially for us as traders, because it's like the air to breathe we need, even though the results are not very or let's put it that way. Now, after volatility picked up significantly, the resulting aspects are not that great anymore because liquidity is thinning out dramatically. And so, in fact, what I'd like to do is guide you through an article which I prepared on Tuesday morning, so 2 days ago. It's still relevant, and then I'll guide you through several charts and graphics from a website, respectively not a website, but it's more like a Twitter account from a guy called Eric Hansader. It's on Nanex LLC. It's very interesting, just to give you an overview of how the charts look like there. 1 second, I have prepared it yet, so it's here. So it looks astonishing, let's say, even though it perfectly illustrates many of the thoughts I will present to you, to just give you insights, and why it's very, very important now to be really careful, and why all moves in the market can be, yeah, pure coincidence, in fact. And nevertheless, before we start to look at those graphics here, first of all, I'd like to show you the article on the website here from JFD Brokers. So just type in jfdbrokers.com in your URL, and then you're guided to the website from JFD Brokers, and there is a separate section. Don't know why it's taken so long now. 1 second. Huh, not so cool. 1 second. Okay, there we go. Now here, then, by the way, let's switch over to English, not German. So you can click on research and education here, and then you get plenty of articles on several assets. In fact, the crash report, that's how we called it, is or therefore you have to do a little search yourself. So right here, you can't see this anymore. You can see there are plenty of languages running in, and it's an English article. So you can click here on English, and then it's filtered, and you get to see all those articles. And here you have the crash report. And if you click on it, then you're guided to this report, and it starts already with some interesting input here on how unique, in fact, this event itself was on Monday in the Dow Jones, respectively, also in the S&P. But let's first of all talk about the Dow Jones here. So the 5th of February will be remembered for a long time. It's now the day on which the Dow Jones Industrial Average lost more than 1,600 points within one trading day. And this, in fact, is in absolute numbers the biggest loss ever. It's bigger than the loss measured in points, in absolute points here. More points that the Dow Jones lost than on Black Monday. That was the 19th of October, 1987, or also on the day when Lehman Brothers collapsed here on the 15th of September, 2008. So now the question is, what happened? And so I'm working out something here, and I try to start to show several pieces of the whole picture here, and then bring them together at the end. So first of all, it was that the market nearly has seen volatility dying. Remember all the times when we sat together here. It's not the first time that I'm holding this webinar today, but it's like taking place every week, and this for 3/4 of a year or something like that. So 9 months probably. I think we started out somewhere in May, June, or something like that last year. And there were plenty of times when we weren't capable of formulating a trading setup based on this setup, I can already present to you here. So 1 second. So this is, in fact, a setup based on which you, respectively, I trade the U.S. market opening and the U.S. markets. And it's not all. There's also a filter I have for myself. You don't necessarily need it, but I have a filter, volatility filter, and saying the market, or the range in this case, which I define here at first, it has to be at least 0.2% of the current index reading, meaning something like, the S&P 500 is trading at 2,500 points. So the open range needs to be minimum 5 points. So 0.2% from 2,500 is 5 points. And this is the minimum range you have to formulate a setup based on 2, respectively 3 then here. And there were plenty of times when we weren't capable of formulating such a setup because the range was smaller than that. So volatility nearly died last year, if you want. And so there were several streaks here, which you can see. For example, the longest streak within a 3% drop of an all-time high, it ended on the 1st of February. That was last week on Thursday already, 1 week ago. It was 311 days. We've never seen such a low volatility streak here. And in fact, it started right before, around, let's say, the election of Donald Trump. So remember, Trump was elected on the 7th of November 2016. So since then, the market is only headed higher on a one-way street without showing any signs of volatility. It's also that since the Brexit here, that was in June 2016, the market saw its longest streak within a 5% of an all-time high here. And it ended also last week on Friday. And so based on that, here, this chart comes into play. It's not perfectly showing that, but we can see that here there was a long period of months where volatility stabilized around 10 and below that, showing the, in fact, quietest market environment ever. And so what market participants did, and in fact, they did it already since the beginning of, or that was not the beginning of the financial crisis, but the end of the financial crisis, and central banks stepping in, supporting the market with billions and trillions, in fact, of cheap US dollar, euro, Swiss franc, British pound, Japanese yen, whatever. The market really came down and calmed down enormously, and there was kind of a light-footedness, let's say. So no one really was scared or nervous about a big crash to happen. In fact, everyone was thinking, and probably still thinking, well, if something goes wrong, central banks will come and probably form an alliance. Probably it's only one central bank, whatever, and then they will start to stabilize the market, buy bonds, deliver liquidity, and calm down the markets once volatility picks up. And in fact, the market created products which are which were used to bet on liquidity volatility to stay low, respectively to sell volatility. So being short volatility, meaning that the market will stay quiet nearly forever, if you want. And no one really cared, or no one really seemed to care about potential setbacks. In fact, at the beginning of the year, something really strange happened. So therefore, and we mentioned this already, you probably remember that. I made, I'm sorry, that's not what I want. Bloomberg. So I said that it's strange. It's strange that the market keeps on rising. Remember what the Dow Jones did here, in fact. So have a look there. The Dow Jones went parabolic since the beginning of the year, starting out here, by the way, around 25,000 points, slightly below that, and then pushed towards 26,500 and even higher than that. And with this rise in equity prices, that was really strange to see that the volatility rose too, which means volatility picked up. I mean, sure, now you get to see a huge spike on the upside, the spike here from Monday, but you can see here that the market already started to buy volatility here, and the market saw an increase in volatility. And was it really nervousness? Was it market participants covering their volatility shorts, preparing for a market drop? Not one bit. In fact, the market prepared for a further rise on the upside and bought volatility, but they bought volatility in form of so-called call options. So there's two forms of options out there. We don't want to go into too much detail here on this topic, but there are call options and there are put options. So usually very easy to understand. Just imagine you have a portfolio of, let's say, I don't know, 10 shares or something, like one share. Let's say you're having a position in General Electric. It's a long-term position, probably because you're a former employee and they gave you some shares here to become a shareholder of the company and to feel really familiar to it. And now you say, well, I don't intend to sell these shares. And so then you have the chance to buy insurance. And you buy insurance with put options in this case on General Electric and saying, okay, if the market falls below a certain threshold, then my share might drop in value here. The price might go lower, even though I compensate for that with the insurance I bought and can stabilize the price at this level I want to see. And this is one way to buy volatility. So if you're going long such a put option and insure yourself from such a price drop, you're buying volatility, in fact. But there's also call options, and call options are betting on higher prices. And this is, in fact, what the market did. So when looking at put-call ratios, you can see that the market got so, and now we come back to this great word. In fact, I had to Google it to really give you the right impression about this in this article here. So the market really got that light-footedness or reached a level of such light-footedness that it was never ever scared of falling prices again, and didn't see the option anymore, but was just like saying, okay, yeah, well, we have to ensure here a certain price level if the market keeps on rising. And this is showing a huge level of greed in the market here and enormous optimism. And it was, in fact, in my personal opinion, only a matter of time when this balloon finally will burst. And that is what happened on Monday then. So the market started to drop lower already from last week, Thursday onwards, even though it was quite stable still. So we saw some pressure here, even though the market accelerated already on Friday and saw the drop then on Monday, an enormous drop. And as already said, one of the biggest drop, no, the biggest drop in absolute points here ever. And so what happened is also, or over the years, in fact, it wasn't just that market sold volatility, but it was also that they bought equities here. It was kind of a risk parity approach which was used. And in fact, let's just Google this again. I did this already in the morning meeting today, but just let us do this again. So risk parity, there's a great article here on Wikipedia, obviously. So you can see it is an approach to investment portfolio management which focuses on allocation of risk, usually defined as volatility, rather than allocation of capital. Risk parity approach asserts that when assets allocations are adjusted, leveraged, or deleveraged to the same risk level, the risk parity portfolio can achieve a higher Sharpe ratio and can be more resistant to market downturns than the traditional portfolio. So we don't want to go into too much details here, but the thing is that such risk parity approaches, well, they played out quite a while and really well. Nevertheless, the billions of dollars which were invested in such approaches, well, they stormed out to one door on Monday, and there was no liquidity left, in fact. So, in fact, market participants dropped their equities and bought back aggressively volatility. This short squeeze in volatility, it's in fact, I have to look it up. So I haven't prepared it, but probably you remember, I have shown this several times, that the market was aggressively short the VIX future. So you can bet on volatility via futures here. So that said, it was obvious that if such a huge short covering happens, that then volatility had to shoot up in some way. And this is exactly what happened. In fact, we saw the biggest rise in volatility here within one trading day ever. So that was a huge short covering where we can now start to probably doubt that it's real risk aversion which drove markets lower, and is probably one very good explanation why the market could recover yesterday that strongly. Even though, and this is the thing for today, and I mentioned this already in the morning meeting, I'm not sure whether we are yet done. I'm not saying that we have such a huge chance to see a significant drop on the downside and making it below the 200 simple moving average here, which you can see in blue. But nevertheless, I think there's a good chance that there's further room on the downside, and probably this will happen within the next day. So somehow I'm very, very skeptical, especially after yesterday. The market rose strongly right from the open and then was sold into the evening again. Well, we were capable of saving some points for the day yesterday. Nevertheless, it wasn't a very strong sign, which we've seen here. And this is something which is now at least raising some doubts at my end that probably there's another push lower, even though at first it will be more kind of a coincidental move. That's something I will present to you a little later on, because the thing is that what caused this dramatic fall in equity prices, this dramatic drop in equity prices on Monday? Well, it was that here, for example, high frequency trading algorithms, so-called HFTs, just shut themselves off. Why is that? Well, they are performing quite well in a market environment which is, let's call it, somehow predictable. And in terms of low liquidity, low volatility, those algorithms are capable of working really well. So the problem is, if a certain threshold in terms of volatility / nervousness in the market is triggered, then they start to reduce their exposure and finally probably start to switch them off automatically, and liquidity dries out completely. And this is the moment when there's really no more buyers in the market then. So to just make sure that you understand how big the impact of HFTs in the market is currently, you can easily Google this here yourself. So if you go to high frequency trading, there's also an article, high frequency trading. You can do to Wikipedia also. What you will find out is that nearly 70% here, previous estimates reporting that HFTs accounted to 60 to 73% of all US equity trading volume, with that number falling to approximately 50 in 2012, were highly inaccurate speculative guesses, even though what you can already see is we have no clear number of how much high frequency trading is done in the market. But it's obvious that here we're talking about a very, very strong market force, in fact. So it's delivering a huge of volume in the market. And if those algorithms shut themselves down, liquidity nearly dries out completely, and the market accelerates here in direction of the momentum on the downside. So now you might say, okay, well, that was the problem on Monday. Now we have Thursday, so everything should be fine again. Well, it's not fine. And I tell you why. Because, and now these charts here come into play. What you can see here is Monday, the day when liquidity dried out completely into the evening here. That was, by the way, when the market accelerated dramatically. But you can see also Tuesday, you can see Wednesday, and you can, in black, see Thursday. That's today. And it's showing that liquidity hasn't returned yet. So what you get to see in the market is likely to be purely coincidental. It's in fact, we don't really know in which direction the market can be driven here. So what I say is we have a great chance with a small block of buying orders to push the market dramatically higher, while it's also possible that with someone pushing the sell button, the market can sell off immediately within seconds. Really seconds. We're not talking about minutes or something. Now, really seconds. And this could have a dramatic impact on the market. So I don't want to scare you, even though this should be something which you keep in mind when looking at the current developments here, and when looking at the, in this case, S&P, for example, which is about to open in around 10 minutes. So currently, everything looks fine. It looks as if the market can really stabilize. So here is the dramatic sell-off on Monday. And now, since then, market was capable of somehow stabilizing. And in fact, I mean, we started the day out here on on Monday around 2,730 points. Just look at this. I mean, we're only 50 points, or something like, let's say 2.5% or something below the opening price from last Monday. It somehow seems as if everything's fine again. The market is recovering. And sure, this is what could happen today, even though we should prepare for higher volatility and also take this into account. Or to put it a little differently, why is this relevant for all of us traders, especially day traders? Well, because if you prepare yourself now for the market opening and have a certain scenario in mind, like the open range breakout scenario, we could formulate a setup on, take into account that probably if you define the risk, let's say you have a risk of something like 10 points, it could be that you're not getting filled until the market stops you out at, let's say, 12 points or so. Especially those traders who are more active in the markets, they will have some serious issue with low liquidity and high frequency in their own trading. Since just imagine someone doing 10 trades a day. So I mean, that's not unusual. And just imagine you're getting filled 2 points lower or 2 points higher, depending on which side you trade, on every trade. And this is 10 times. So that means you're already getting a fill of 22 multiplied with 10, 20 points worse than you would usually get in a normal liquid market environment. So usually that's something you could probably get rid of with a broker like JFD, for example, who has a huge pool of liquidity providers and who has already established a name for delivering really great quality of order execution, even during times of high market volatility and low liquidity. So why do I say that, or how can I prove that? Well, one second. I just showed you one chart, which is perfectly illustrating this. I just hope that, by the way, I can find this chart right now. But usually it shouldn't be such a big deal. One second. I just have to look it up here. I retweeted it on, no, it wasn't retweeted. It was more like, okay, no, that's not cool. Okay, let me just see whether I can find it here. Yes, there we go. Okay, one second. So this is my LinkedIn profile. And you can see here one article which was shared. And this graphic is showing the broker's maximum Euro-USD spread during the NFPs on Friday, last week on Friday, and how the brokers here performed there. And you can see that JFD obviously has the tightest spread within a range of several other brokers. And you can see here, you have a MT4 spread monitor as shown in the MT4 terminal of the respective broker. And they're only brokers with variable spreads which are used here for comparison. And as you can see, obviously, JFD Brokers is performing exceptionally well. The reason for that is if liquidity thins out during those market events, especially like NFPs or also during flash crashes or in general right now in market environment, low liquidity, the idea behind this is always the same. Usually, the tighter the spreads, the more the higher the quality of the liquidity pool the broker is using. And this is especially true for those brokers or traders, no, not brokers, but traders who are looking for a broker where they can generate lots of volume. So institutional traders, respectively, traders like me managing clients' funds. We are always looking for brokers who deliver exceptionally great liquidity to never run into trouble in terms of order execution in general, but also during times of high volatility. So, and now the thing is, let's come back here to this. I mean, even if you have such a broker, it's not sad that you have no real problem here to find liquidity, or that the markets do not jump in one or the other direction or behave in an unusual way. In fact, at the end, even this can't or does not mean that you're not running into problems here. Probably you're running into less problems than when trading with another broker, or than as if you are trading with another broker, even though low liquidity is a topic for all brokers because we are all looking at the same market. So, and that said, you have to keep this in mind when setting up a position. So meaning nothing more than the impact this flash crash had on the market means that liquidity thinned out. In fact, there was some, I think it was zero hedge. I've seen it there. It was where it is currently similar to 1987 when market makers, equity market makers, didn't answer the phone anymore. So times have changed. So we are not talking or not taking orders by phone anymore. And we don't need to call our brokers, but we do this with our trading platform. But this is exactly the same thing which was happening back then, and now you can see it here with your own eyes. So if the market is not taking place anymore, and market participants are just stepping back from the action, taking out their bids, taking out their offers, there's a high chance that erratic moves start to take place. And this is in fact something which is also mentioned here. For example, low liquidity equals, I'm sorry. Why is that? 1 second. Low liquidity equals erratic pricing. Here's how often the price changed in each 10-minute interval of each day this year. The last few days are a bit different, which is of day, Eastern time, and so on. So the charts are usually a bit difficult to understand. I completely agree, even though they're invaluable or there's invaluable information here for active traders. And what you can see is that the market obviously obviously behaves in a very erratic way right now. And also here, just to make sure that you get the idea behind this. So probably, why is this happening all the time? That's not so cool. So here, I'm not sure how familiar you are with the flash crash in 2010 and what happened there, but it was in fact the first flash crash which was somehow recorded and people are familiar with, and where people got in touch with HFT algorithms and all that stuff. Well, what you can see here is liquidity was really low back then already. Right now, we see nearly no liquidity at all anymore. And with this in mind, this is also something, and all the time something. It doesn't matter how big you trade. In fact, the bigger you trade, obviously, the more it matters. But also for small traders, keep this in mind, and based on that, adapt your position size accordingly. So it's, I think, necessary to tell you that this currently is a market environment in which reduction of the position size is imminent if you're thinking in a professional way about your trading. So that said, let's now have a look here at the market opening in the S&P. In fact, I just want to tell you the following. I have to be careful myself. As you may know, I mentioned it already, but I have a position on in the DAX 2. It's a systematic trade, in fact. And currently, the market is moving my direction. Just let me show you this trade here. 1 second. I first have to open here the trading platform. So usually I don't have it open here since it's too much resources, and I run the platform on a VPS here, so on a virtual private server. Nevertheless, I just hope that it's not killing. No, there we go. Yeah, there we go. So there you can see that I have a position on, and I'm on the short side, even though the position size is already quite low. And I have to say, and that's something you probably... Okay, that's not good. So I can currently see that now my connection was lost, obviously. So probably it's better to probably take out here. Okay, here I am again. So can you hear me? Can you just let me know whether you can hear me? So usually you should hear me. Nevertheless, it's not sad that you can still hear me, since again this costing some of the resources from my system here. But again, the reason I show you this is very simple. So I just want to show you that yes, I am positioned, and yes, I'd really appreciate to see another drop similar to the one from Monday. Sure, if you're positioned on the short side, even though again we're not talking about a mega huge position here. So that's the only thing I want to show to you here. And then why I opened the platform right now, so you can see the position here. Just have a look, and now I'll shut it down again because again, resources used here from the MetaTrader are it's a little too much. And so what I'm looking for currently, and let me just show it here to you, is in fact what I hope for is that the market will again test the level of the current intraday lows, 12,400, 410 points here. And if we break below that, the next crucial level, also mentioned in my technical piece for the day and also in the morning meeting in the morning, is 350. So the region here around this low, this is an intraday region which I consider to be relevant. If we push below this level, I think there's further room which could easily push us another 200 points down to 12,150 in the DAX, and probably even lower than that. So meaning that we have probably also a chance to see another huge drop and crash here, pushing us towards 12,000 points and lower, 11,900 points. And that's why I'm right now quite happy to be on the short side, even though I don't know what will happen. So again, I depend on market liquidity here too. And for whatever reason, and in fact, it could just be one buyer coming into the market, he could easily push the market based on low liquidity currently aggressively higher. That's no real big deal in the current market environment. On the other hand, if sellers coming in and panic again, and this is the thing, so that's why I referred to all this before, and to make sure that you understand and which difficult market environment we are in. So the market has already seen a huge squeeze in volatility on Monday. Okay, great. So, but the thing is, I'm again not sure whether we are yet done. And probably market participants who panicked on Monday and dumped first part of their aggressive short volatility position, respectively equity long position, well, where probably they're sitting on a huge package here on short volatility and long equities. They're still sitting on such a huge position here, meaning from rather sooner or later, they probably think, okay, now we have to reduce our exposure here, keep on reducing it. We waited for the market to stabilize. Unfortunately, it stabilized, yes. Nevertheless, the liquidity is still low, and we somehow need to get rid of our position here. And they dump one package, and the market is just falling apart again. And this is exactly what we should prepare for, and why probably also it makes sense to consider risk rewards on the short side to be better than on the long side. So in fact, yesterday's price action here in the Dow Jones came to me with a surprise. So when I saw the market pushing here and aggressively being bought right from the open, the market pushed higher, and I have to be honest, I was sitting in front of the screen and just thinking, you know what? I expect the markets or the week to turn green today. So I expected really the market to attack and push back above 25,500 points here yesterday already. And it looked really good right at the beginning of the trading day. But then, for whatever reason, into the evening, the market wasn't capable of keeping this momentum up here, but instead sold off again and was only capable of holding a small green force sign here in this case. And this is something where I say, well, that's probably first sign of weakness, and probably a first sign that first market participant started to dump again positions into this move higher here. And that's something which is currently definitely something to consider when taking positions on. So make long things short, I don't like long positions in the current market environment. So I really don't like them. I would have liked them if the market was capable of pushing back above the open here, or in case of the DAX, if yesterday the DAX pushed above 12,650 points here, but we didn't make it. In fact, we sold off again and dropped towards 12,400 points. And this is in my opinion, very, very weak sign. And with this in mind, I'd say, well, probably it's better to look for short engagements, since there seems to be still a lot of pressure be possible in the upcoming hours then. And that's why I definitely prefer the short side here. So yeah, so with this in mind, these are my thoughts on the DAX. Now we highly depend on the US equity markets. As you can see, for example, when looking at the Euro USD here, you can see that the aggressive drop, so US dollar recovered already quite strongly after sawing some huge losses, accelerating losses after the comments from Steven Mnuchin here in Davos around, is it 2 weeks ago? 2 weeks. It's 2 weeks ago, yes. That was here on the 24th of January. And so we're making back all these losses, but somehow the dollar is still vulnerable to further losses. So even if we now made it back towards and slightly above 90, obviously we can take on further momentum. Nevertheless, the recovery here, which took place over the last days and accelerated yesterday especially, pushed the euro lower. And what we know is that a strong euro usually is something negative, or is considered to be negative for the DAX currently, the current market environment. But the DAX decoupled from this negative correlation here nearly completely. Right now, only looking at what Wall Street delivers. Usually what you should have expected is the drop here in Euro USD happening. That should usually have pushed the DAX higher. Instead, the DAX wasn't capable of taking on any momentum, which means if now Wall Street falls apart again and drops aggressively, then probably here, even this push higher now in the Euro USD, and probably potential push back above 123 is capable of weighing more aggressively, even more aggressively than on the DAX, and pushing the DAX even lower. Even though right now I definitely wouldn't focus on the FX markets here on the euro, but focus on the Dow Jones and how the Dow Jones performs, and respectively the S&P. And yeah, let's just see. So currently we're still working on our open range. So the setup is very simple. What we will do is we will just wait here for another 30 to 35 minutes, 2:30 till 3:15 p.m. GMT. Then we have a high and a low. And what we'll do is we will place a buy order above the high, a sell order below the low of the range, and trade in direction of the identified advantage, which will be identified based on the 15-minute exponential moving average 10, meaning nothing more than we're trading above that, we are only going long, we're trading below that, we are going short, and that's in fact it. So let me just show this to you via an simple example. So let's just have a look at this from yesterday. So yesterday, for example, didn't work out. Why? Well, we look here at 2:30 p.m. GMT. Where's the low? It's 2,687.5. So you can't see this here. By the way, some of you might probably wonder why, what all these lines mean. So let me just first of all here have this purple line, even though I will now take it out here and then replace it again. So first of all, the green line here is the low from yesterday. So we closed at the lows from yesterday. The blue line is the closing price. This here, the turquoise line, is the first tick of today. So it's the spot open, in fact. The red line is the high from yesterday. And this moving average here is the exponential moving average 10. So based on which we identify our advantage for the market then. And now we place, one second, we place it here. So this is the low from yesterday. And then you have the high here. So this is the high. So you can see here the purple line, and you can see here the the other purple line, the high of the day, high, and here's the low of the day. So now we're trading obviously above the exponential moving average 10. So we are trading in direction of this identified advantage. So this is the candle you have to wait for. And in fact, we were already triggered here. No, we can see this. One second. So we are already triggered in the next candle here with the short spike, even though the market didn't take on momentum, but pulled back and then took on momentum. Broke higher, which is great. But now then it's turned lower. And in fact, we were stopped out here shortly. Oh, in fact, by the way, I'm not sure. Well, probably we've only seen a small loss, because this is the thing. We weren't necessarily stopped out here, since the market takes out the position at 7:50 p.m. GMT. That's an automatic stop out. So we are holding a position over the whole spot market, or the whole trading hours when the spot market is open, and then the position is taken out at 7:50 p.m. GMT automatically. As you can see, we dropped during the last 50 minutes of trading, but I think that was the last minutes of trading yesterday, in fact. So it could be that we were stopped out. So that was the candle we were stopped out, right? Yes, so here. So we were taken out at 695, so here. So it's not the lows, 17 points lower, but 17 highs higher, which is positive to our overall trading result. It means a lesser impact, or a negative impact, on our equity curve. So meaning we had a smaller loss. But nevertheless, it was a losing trade. And this is, in fact, how this setup works. So you're waiting for the first 45 minutes of spot trading taking place. Then you trade the break in direction of the identified advantage. We're trading above the, in this case, yellow line, exponential moving average 10. We're going long. We're trading below that. We're going short, and that's it. So currently, for example, we are losing here. And now we wait another 30 minutes. And then if we trade below this yellow line, we're going short for today, and the other way around. By the way, some of you might probably wonder, how did the system perform here on, how did it perform? Not so easy. 1 second. Oh, I just hope that it's right. Yes. So some of you might probably wonder how the system performed on Monday during the flash crash. In fact, unfortunately, it lost money because it was long. That's the problem. So that's the day of the flash crash. Here is the open range. It's defined between here, the low from this candle, 2,734, and here's the high, 615. Oh no, in fact, that's the candle here. That's this candle. So we were triggered long here. The market moved in our direction and then dropped. We were stopped out, by the way, with the stop here being placed below the low of the day and the low of this open range. And then the market fell apart. So we saw a loss, which is not nice, but it's nicer to see such a loss than, instead of being long here, having no stop and seeing the market tumble 200 points here. So in fact, we saw a small loss. Unfortunately, we were in position on the short side, even though such an approach here, the open range breakout, is in fact a very great approach for intraday trends. So sometimes they don't develop, but if they develop, and you're positioned on the right side, you're probably in very good shape and see a market, not just trending in a direction, but generating an interesting and huge profit here. And by the way, you need those trades because the hit rate is slightly below 50%, meaning that you have to generate significant bigger gains than you generate losses here. I will show to you, by the way, the performance of this strategy with a back test in a few seconds. Just let me check what the DAX is doing here. I mean, I prefer to see the S&P not to recover any of these losses. Yeah, we're dropping. This is great. So again, 12,400. I'd like to see market pushing below that level. And again, 350 is the key level to watch. Yeah, let's just see. So some of you probably now might wonder, does this strategy really work? And yes, in fact, it does. I haven't prepared a picture yet, but I will show it to you in a few seconds. So it's here. So it's, oh, I'm sorry. This is the equity curve. The strategy with those parameters, some of you might probably wonder, can this really be profitable? I mean, we're not talking about something really impressive. So this strategy seems to be really ridiculously easy. And it is, in fact. It is, because you just run through these 3 steps every day. Define the open range, identify the advantage, place your order, see the order filled, see how the market develops. That's it. And In fact, this is the good thing about the strategy. It's easily duplicable. So you can, by the way, easily program this approach here and run those back tests yourself, by the way. If you have enough data available, you can easily see how the performance was during the last years of trading. And what you can see is that here, a backtest was run for this approach. And you can see, by the way, for example, the 10 here. So what is meant by this is the exponential moving average. So it's a simulation run in, or a backtest run in Excel. Yeah, what you can see is that there you have the win rate. I said slightly below 50%. You can see it here, 47%. You have the average profit. You have the average loss. If you fill in those components here into the formula around the expected value, you will find out that this approach on average makes 8 cents per euro, dollar, whatever you're risking. So it doesn't sound that much, but let's assume you're trading a 100,000 euro account and it's 1,000 euro risk you're taking per position, 1%. This 8 cent mean that you're making on average 80 euros per trade. And no matter whether you're winning or losing, you're making this on every trade. Okay, and it has a positive expected value, and over a number of trades here, you can see that there's obviously a positive result being generated. And I think this equity curve, especially when looking at the max drawdown, which was, and again, there's no optimization has taken place here so far. So you can easily adopt it with some discretionary input parameters, like saying, well, if I see the market running in a strong resistance, it probably makes sense to be more aggressive with the stop here and not to, if you're well ahead on this trade, not to risk to the market taking away your gains from you anymore, for example. Even though still, if you don't do this, again, the strategy is profitable. So in the basic version, the strategy is profitable, performing really well, and generating obviously positive expected value. And again, clear parameters are given. You can just use them, place the orders based on them, and that's in fact it. Yeah. And so now the question is, we have 10 minutes left. If you have any questions, please shoot them over. If something's not clear, or if you're interested in other markets which we can cover here, or whatever, just let me know. So I'd really like to answer your questions. First of all, nevertheless, I want to have a look here at my trade in the DAX. So we push towards these lows. We haven't yet seen a significant break. Let's see whether the US markets deliver the push on the downside, which is definitely needed to let the DAX breaking lower. So again, I really appreciate the weak start into the day. You can analyze whatever you want. I mean, at the end, it's like I have an opinion, especially my opinion right now is driven due to the fact that I'm short the DAX. So you won't hear me formulate a strong bullish market environment right now. So something you definitely have to take into account. So if you now look at the market and say, well, what is this guy talking about? I'm aggressively long here for whatever reason. That's completely fine. Yeah, that's completely fine. Nevertheless, you hopefully understand that I'm sure on the short side right now because of my own position here. So a question, what about Euro Australian dollar? Let's have a look. I, in fact, haven't had a look at Euro Australian dollar for quite a while. And in fact, I can right now say it's not interesting for me. It's not interesting for me since it looks bullish. And why is it not interesting for me? It's because of the negative role I have to expect when holding such a position. What do I mean by that? Usually when I trade equity, when I usually trade equities, I hold these positions intraday and I'm not holding them overnight. But this is completely different when I trade FX. So which means usually my FX trades are compared to my equity trades more long-term, meaning I hold them at least several days. And when I hold such a position, I highly prefer trades which generate a so-called positive roll so that I get paid for holding a position overnight. Case of Euro Australian dollar, that's not the case because the Euro has a significant lower yield level than the Australian dollar, which means that I have to pay for holding a long position. And that's one of the reasons why I don't really like this, because I have to overcome not only the commission I have to pay on the trade, I mean, yes, I'm trading with JFD. Commissions are really, really low, very attractive for active traders too. Even though, nevertheless, if you think in a very professional way, it's costs which are generated and which you want to somehow avoid / at least somehow reduce them. The cost of doing business here, as usually every trader or businessman or entrepreneur or whatever will usually do. And so that's one of the reasons why I don't really like long positions. But from a pure research perspective, I have to say that this looks quite strong to me here, this push lower. No, this push lower towards this breakout level here. And that currently I favor the breakout on the upside with a target probably around the highs here from 2016. So push towards 160 and higher than that. So this is, my favorite scenario. And in fact, by the way, it perfectly coincides with my overall look for Euro USD, for example, but also for Australian dollar USD. First of all, let's have a look at Euro USD here. Where is it? Here. We already had a look at this. I have to say that I prefer long engagements here, since I expect rather sooner or later the push towards 125.50 and above that level, probably towards 130. There's one thing which could definitely be negative for my outlook here for Euro USD. That has something to do with the political landscape here in Germany. So right now, the Grand Coalition is forming. And so far, it looks as if the Christian Democrats and the Social Democrats find together again for another 4 years. It's not very positive for the overall outlook for Germany, not in terms of economy, not in terms of financial situation, especially because Social Democrats are now taking over the finance minister position here. Nevertheless, it's not a done deal yet. That's something many people probably didn't recognize yet. The thing is that the Social Democrats have to vote, the whole party, so meaning all the base of the Social Democrats have to vote for this coalition contract, and they are against it. It's something where we have already seen a very, very it was a very close decision, in fact, to step and take talks with the Christian Democrats on this Grand Coalition. And there was a chance to, let's say, somehow manipulate this or somehow have a small small majority here to then start these talks. But now when they talk to all those Social Democrats and the basis of this party, chances are high that there won't be a positive outcome. This said, means Euro could be hit quite hard over the next weeks if there's a no from the Social Democrats. This is something you have to take into account also for Euro Australian dollar, but also for Euro USD. Even though if you don't take this into account, well, then I have to say that there's further potential on the upside, also because Australian dollar USD, for example, looks vulnerable to further losses after we've seen a quite strong run here, which did not coincide with big speculators in the Commitment of Traders report, for example, building up Australian dollar long positions, but instead reducing it and building a quite huge short position in Australian dollar. I haven't a picture right here, but just believe me, that's just the development which took place here over the last weeks in the Commitment of Traders report. So with this in mind, and if Euro can really take off again, and there's probably the yes from the Social Democrat basis, then Euro Australian dollar has some further potential on the upside, I think. Nevertheless, keep in mind these talks around the political situation in Germany. It could come out as a big disaster for those two parties, and there would be a vacuum, a political vacuum here in the biggest economy of Europe, and that's definitely not positive for our currency then. So live with it. It sounds it sounds very easy, but in fact that's exactly what I do. So sometimes prices spike up on side of the initial price range and then go out of the range on the other hand, stopping you out of the trade. So what do I do in these cases? So in fact I just I got used to it over the years. I just accept it. The thing is that if you run a back test, you're analyzing over 1,347 trades here. Counting. So we're like well, something like 1,500 trades right now, since this is a back test which was run between November 2010 till June, July 2017. And so the thing is, there are plenty of those occasions when the price spikes out on one hand and then goes out of the range on the other side. Like Monday, for example, I've already shown this during the flash crash. I mean, if you were short, you made a huge a gain on this trade. Unfortunately, the system went long based on the rules we put in the system here, the parameters around the system. And so nevertheless, obviously, this happens quite often during this time. Probably also an explanation why the hit rate is not very big. It's something where you can start to optimize the system, something definitely to consider here, and where a discretionary approach can or could come into place. Nevertheless, you can see that the basic strategy is already profitable, even if such a development happens here. And so based on that, it sounds simple, but in fact, that's exactly what my answer is in this case. I just got used to it and I accept it. It's not nice, not one bit. Again, perfect example, Monday. You really want to be short and seeing the market falling apart here, but knowing that you're not positioned because, oh, I'm sorry, no, this is the DAX. Again, here, let's have a look at the S&P here. Seeing the market falling apart here, but knowing that you're getting stopped in here and then facing a loss of something like 0.8 to 1% of your equity, yeah, that's not cool, not one bit. Nevertheless, it's just one day. It's one day which will be remembered. Again, let's have a look here at this crash report, which we want to probably then finish this webinar here. It will be remembered for quite a while, this day. Nevertheless, the thing is, it's only one day out of hundreds of thousands in your life of a trader, and that's not causing any problems here. In fact, if you see a significant impact on your equity curve only based on one trading day, you should definitely think about your overall trading approach, because it could mean that your strategy itself is quite fragile and not robust enough, and you need to adapt certain parameters probably, because one strategy shouldn't be profitable of only one trade alone. That's something very, very important to remember. Yeah, and so that's it from my end. So thanks for your attention. I just hope that you can take something with you here. If you have any questions, please send me an email here. This is my mail address, j.klatt, K-L-A-T-T, @jfdbrokers.com. Contact me via Twitter. Please give the YouTube channel from JFD Brokers probably a like, so you'll be reminded of the webinars taking place, morning meetings, that stuff, and happy trading. Have a nice day. Talk to you again next week. I definitely look forward to it. Take care. See you, and bye-bye.